If you only look at the statewide headlines, Ohio's housing market in 2026 can still seem surprisingly stable. Prices are not falling everywhere. Buyers are still active in many communities. Homes are still selling. And compared with expensive coastal markets, Ohio can still look like one of the more practical places in America to buy a home. But that is exactly why so many people are missing what is happening underneath the surface. Because real estate markets do not always break all at once. They do not always announce trouble with one dramatic crash, one giant headline, or one obvious turning point. Sometimes the shift is quieter than that. Sometimes it starts with demand softening in places that were supposed to feel dependable. Sometimes it shows up in the cities where homes still look affordable, neighborhoods still look solid, and sellers still believe last year's pricing should hold. And then, little by little, the market changes. Homes sit longer. Buyers pause instead of rushing. Price cuts become more common. The number of offers starts to shrink, and suddenly the market is no longer being controlled by confidence. It is being controlled by hesitation. That is the real Ohio story in 2026. Statewide, Ohio was still posting year-over-year price growth in February 2026, with a median sale price around the mid-$250,000 range. But homes were also taking longer to sell, and transaction volume was softer. That matters because it tells us the market is no longer moving on momentum alone. It is starting to split. Some places are still holding up, some are running out of steam, and some are sending early signals that the next phase of the market will be much harder on sellers than the last one. This is not a video about fantasy. It is not about calling for a statewide collapse just to sound dramatic. It is about understanding where leverage is shifting, where buyer psychology is changing, and where real estate is becoming more fragile than it looks from a distance. And if you are a buyer, seller, investor, or homeowner watching from anywhere in the U.S., Ohio matters more than you may think. Why? Because Ohio has long represented the sensible side of American housing. It is the kind of state people point to when they talk about affordability, value, and markets that are supposed to be insulated from the chaos of overheated real estate. So when pressure begins to show up here, it tells us something important. It tells us that affordability alone is not enough to protect a market when confidence starts to weaken. And in 2026, that weakening confidence is becoming easier to spot. Let's walk through the Ohio cities where the earliest warning signs are becoming harder to ignore. Let's start with Grove City. Grove City matters because it represents a very specific kind of suburban confidence. This is not a market people associate with speculation or hype. It is close enough to Columbus to benefit from regional growth, but still suburban enough to sell the idea of space, routine, schools, and predictability. That is what buyers are paying for here. Not excitement, not status. Stability. But that image becomes vulnerable when prices stop cooperating. In February 2026, Grove City's median sale price was down year over year, while homes were taking longer to sell. That combination is important because Grove City is not a place where people expect softness. When a market built on reliability starts showing weaker price support, the emotional shift can be fast. Buyers stop thinking, "I need to act now before this gets more expensive," and start thinking, "Maybe I should wait and see what happens next." That is a major change in psychology. Once that happens, listings need more time, sellers lose urgency on their side, and the suburban certainty that once supported pricing starts to fade. Now look at Dayton. Dayton is a different type of warning sign. It is still relatively affordable, and on paper, it may not look disastrous at first glance. But affordability can create a false sense of safety. Buyers often assume that lower-priced markets are naturally more protected because the numbers feel easier to justify. The problem is that affordability only helps when buyers still believe values are stable enough to support the purchase. In Dayton, the bigger issue is not simply price. It is tempo. Homes are taking noticeably longer to sell than they were a year earlier, and when a city like Dayton starts losing speed, the effects can spread quickly. Buyers feel less pressure. Sellers get less immediate feedback. Listing inventory stays visible for longer, and the longer homes remain on the market, the more buyers begin to expect negotiation, credits, or price improvements. That is how a market can weaken even before the headline numbers look dramatic. Dayton shows how time itself can become a warning sign. A slower market changes behavior, and once behavior changes, pricing power usually follows. Then there is Lancaster. Lancaster is the kind of market many buyers were drawn to because it felt manageable. It offered breathing room, it offered distance from major city pricing, without feeling too disconnected from opportunity. It was the type of place people chose when they wanted the numbers to make sense. That is why Lancaster stands out in 2026. When a city like this posts a meaningful year-over-year drop in median sale price, it tells us something deeper than a simple fluctuation. It suggests that affordability is no longer creating the same sense of urgency. Buyers are still interested, but they are more selective. They are comparing harder. They are waiting longer. And once buyers believe softness exists even in a modest market, their behavior changes immediately. They stop bidding against the future and start negotiating against the present. Lancaster is a reminder that real estate does not have to freeze to weaken. A market can stay active and still lose pricing power at the same time. Now consider Lima. Lima may be one of the clearest examples of why low prices do not automatically equal low risk. On paper, Lima still looks inexpensive. That alone makes it tempting for first-time buyers, budget-conscious households, and investors who assume lower acquisition costs mean lower downside. But in real estate, affordability without momentum can be dangerous, and Lima is showing exactly why. In February 2026, prices were roughly flat year over year, but homes were taking dramatically longer to sell. That kind of slowdown changes the mood of a market fast. Once buyers realize they no longer have to move quickly, patience becomes their advantage. They revisit homes, they wait for reductions, they make lower offers, they ask for more repairs. And when sellers in a low-cost market start facing that kind of patience from buyers, even small pricing pressure can have an outsized impact. Lima is not sending a message about drama. It is sending a message about drift, and sometimes drift is how weakness becomes permanent. Next is Middletown. Middletown is especially interesting because it shows what happens when a market loses its cushion. This is a city that depends on practical buyers. People here are not typically chasing lifestyle prestige or luxury branding. They are trying to make a financially sensible move. That means the market is especially vulnerable when confidence becomes uncertain, because the decision is usually rooted in math more than emotion. In 2026, Middletown has shown signs of that pressure. Prices slipped modestly year over year, homes were still taking time to sell, and the average property was not generating a flood of offers. That may sound manageable, but in a market like this, modest weakness matters more. There is less excess demand to hide it. There is less prestige to defend pricing. There is less margin for error, so even a small shift in leverage can become meaningful. Middletown is what a market looks like when the seller is still participating, but no longer truly in control. Now let's move to Springfield. Springfield may be one of the more deceptive markets on this list because the activity can still make it look healthy. Homes are selling, transactions are happening. Buyer interest has not disappeared, but that does not mean the market is strong. What matters here is that prices moved lower even while sales activity remained alive. That is an important distinction. A market that freezes is easy to identify as weak. A market that keeps moving while prices soften is trickier, and in some ways more dangerous because the softness becomes normalized. The deal still closes. The yard sign still changes, the house still sells, but it sells at a weaker number than the one sellers expected to defend, and over time those weaker numbers reset the market. Springfield shows how a city can look active from the outside while the floor underneath pricing quietly moves lower. Now let's talk about Xenia. Xenia is another case where the surface can fool people. Homes are still moving, and in some cases they are moving faster than before. But faster sales alone do not automatically mean strength. If sales volume is thinner and prices are softer, speed can sometimes reflect a different reality. Only the most competitively priced homes are getting attention. That is the risk in Xenia. A smaller number of completed transactions means each comparable sale carries more weight. In that environment, even a few weaker deals can influence expectations across the market. Buyers begin to assume flexibility. Sellers start entering the market knowing they may not get the number they wanted. And once enough people adjust to that new expectation, the price structure itself begins to soften. Zinnia is important because it shows how a market can remain functional while confidence still fades. Then there is Cleveland. Cleveland matters because it is one of Ohio's most visible housing stories. It has national recognition. It has revitalization narratives. It has neighborhoods that attract local pride and outside interest. For years, Cleveland has benefited from a broader belief that it still had room to grow, room to recover, and room to surprise people on the upside. But that kind of narrative only works as long as the numbers cooperate. In 2026, Cleveland has shown enough softness to raise serious questions. Median prices were lower year over year, homes were taking longer to sell, and completed transactions were down. That does not automatically mean collapse, but it does mean the recovery story is being tested. Buyers do not only purchase in Cleveland because it is affordable, they also buy because they believe they are entering a city with momentum. The moment that belief weakens, the market loses more than pricing power. It loses story power. And in real estate, the story buyers believe about the future matters almost as much as the house they are buying today. Now let's look at Lakewood. Lakewood is fascinating because it is not showing stress in the same way as the other cities. Prices were still up strongly year over year. That sounds bullish. But the deeper signal comes from volume. Far fewer homes sold compared with the year before. That matters because high prices supported by lower transaction depth can create a misleading picture. In a city like Lakewood, buyers are not just paying for square footage. They are paying for character, walkability, established neighborhoods, proximity to Cleveland, and a lifestyle identity that feels hard to replicate. That can support stronger pricing for longer than in more generic markets. But if the buyer pool begins to narrow, even a respected market can become more fragile than it appears. When fewer buyers are willing to meet premium pricing, the market can still look strong on median price while becoming thinner underneath. Lakewood is not the obvious weakness story. It is the subtle one. It is the reminder that a premium market can lose depth before it loses price. And finally, there is Warren. If one city on this list captures the harshest version of Ohio's 2026 pressure story, it may be Warren. Warren's numbers are difficult to ignore. Prices were down sharply year over year. The sale price per square foot also dropped meaningfully, and homes were taking much longer to sell than they had a year earlier. That is not a minor adjustment. That is a market resetting itself in real time. What makes Warren especially important is that it challenges one of the most common myths in American real estate, the belief that cheap housing is automatically safe housing. It is not. A low price can attract attention, but it does not guarantee stability. In fact, when a low-cost market starts to weaken, buyers can become even more cautious because they know there is not much lifestyle premium or scarcity premium to defend valuations. If they think the next sale might come in lower, they wait. And when buyers wait in a market like Warren, sellers feel it immediately. So what does all of this mean? It means Ohio in 2026 is not one story. It is a map of different stories happening at the same time. Some cities are showing slowing demand. Some are showing price erosion. Some are showing thinner buyer pools. Some are still active, but at weaker numbers. And some still look relatively strong, yet are beginning to lose the depth that once made that strength feel reliable. For buyers, that creates opportunity, but only if you stay disciplined. This is the kind of market where patience has value. Do not mistake an asking price for market truth. Watch days on market. Watch price cuts. Watch how often homes come back after failed contracts. Ask whether the seller has already adjusted once. In a shifting market, leverage often belongs to the buyer who is calm enough to wait. For sellers, the lesson is harder but clearer. Pricing for yesterday is one of the fastest ways to lose time in today's market. If your city is slowing, the market will punish overconfidence. The listing that feels just a little high can become the stale listing buyers use to negotiate everything else downward. In this environment, serious sellers have to compete on day 1, not day 21, not after the first reduction. Day 1. For investors, Ohio should be a reminder that affordability is not the same thing as immunity. A cheap market can still be risky if demand weakens, exit liquidity shrinks, or rent growth fails to compensate for softer values. The smartest investors in 2026 will not just ask, how cheap is it? They will ask, how durable is demand? How liquid is resale? How much negotiating power do buyers now have? And for everyone watching nationally, Ohio offers a broader lesson about U.S. real estate. The next chapter of housing may not be defined by one giant national crash. It may be defined by local stress, uneven leverage, slower absorption, and a long repricing of confidence. That kind of market is harder to read. It is less dramatic, but it is often more important because it is where people make expensive mistakes while telling themselves everything still looks normal. That is the real warning. The lawn is still cut. The house still photographs well. The neighborhood still feels stable. The state still sounds affordable. But the market underneath is changing. And if you only look at the headline, you will miss the part that actually matters. Ohio is not falling apart everywhere in 2026. But in market after market, the message is getting clearer. Sellers no longer have the same protection, buyers no longer have the same urgency, and real estate no longer gets to rely on affordability alone. And once that shift begins, the smartest people do not wait for the headline to confirm it. They move before everyone else finally sees what the numbers were already saying.